Hey, what's up, everybody? It is Monday, March 28th. Hope you had a nice weekend. Did you watch the Academy Awards? Will Smith smacking Chris Rock. I thought that was pretty cool. I did not watch the show, but I definitely watched that video clip of him smacking Chris Rock. I thought it was pretty cool. Hey, I found out something today that the heat from a hydrogen bomb explosion, the heat at the initial moment is 100 million degrees Kelvin. It's basically 100 million degrees centigrade plus 273 degrees. We could forget about the 273. It's really irrelevant. 100 million degrees Kelvin, that is the heat, the temperature of a thermonuclear, a hydrogen bomb explosion. And the reason I found this out was because I was listening to a very interesting podcast today. A guy named Ted Postol, P-O-S-T-O-L, you should look him up. He is an MIT professor and he is a nuclear arms expert. He's worked with several administrations. And he really laid it out in this podcast. Also, there's a video online. He participates in a panel talking about what would happen. I mean, the destructive power of these weapons is just unfathomable. And we better hope to God that it does not come to a nuclear war, because we are all dead. We are all dead. But let's focus on happier things, like the market being up today. There's not a lot to talk about. I mean, we understand the environment we're in right now with central banks raising interest rates. They believe that this is the remedy for inflation. They're going to be disappointed on this, but it's not going to change their mentality, because this is like a mythology within the profession of economics, at least, mainstream economics, as most of these institutional guys have learned it. And we see this all over. I mean, practically every single video I talk about the idiocy of this whole thing. If higher interest rates were the key to controlling inflation, then you would not have inflation in places like Turkey and Venezuela and Argentina and all these other places where they raise interest rates through the roof. Plus, it doesn't help their currency. You see all these currencies really, really weak, and every time they raise interest rates, they just keep getting weaker and weaker. And vice versa, you see the opposite effect in Japan, and even though the yen, a lot has been made recently of the yen at a 7-year low against the dollar, and to me, I find that a little bit surprising. But if you take a look at a long-term chart of the yen that goes back at least, till the 1970s or the early 1980s, I mean, that dollar-yen exchange rate, where it is right now at 122, 123, that's still a very, very strong yen. I mean, when Japan really started to come on the world stage as an economic power in the 70s, the yen was, I think, around 400 to the dollar. So, I mean, we're still, even though it's not where it was in like 1995, 96, or more recently, I guess in like 2007, 2008, the yen is still very strong in any kind of a historical comparison. But what I was going to say is there's another example right there of this interest rate fallacy, that low rates, according to the logic, the crazy logic, the wrong logic of the mainstream economics profession, central bankers, etc., low rates should be extremely bearish for the yen. And again, I acknowledge that the yen has fallen, in the last 2 years or a year and a half. But at the same time, if you take a more of a macro view of where it is, I mean, it's very strong. It's still very strong. And there's no inflation. Yeah, we were talking about the inflation at rates as a remedy against inflation. I mean, according to that logic, again, you should have, or we should see, like hyperinflation in Japan, because they've been holding rates negative, and by their thinking, by institutional thinking, that should contribute to super high inflation, and you're just not seeing that. I mean, the Bank of Japan has been on a mission for I don't know how many years, like many years, just to try to get the inflation rate up to 2%. And their prescription is to keep rates zero or negative, and they're just kind of scratching their head, saying, well, why is it not happening? Why is it not happening? But again, it's classic Einstein's definition of insanity. You just keep doing the same thing over and over and over again, expecting a different result. Let me talk a little bit about the fiscal situation. Still very strong. I mean, we're looking at probably March closing out with close to 650 billion in total flows. You have to go back to July of last year to see flows of that level. And of course, that was positive, very positive for the economy. It was very positive for the stock market. Unfortunately, right now, we have an offsetting factor, at least one, but more. We got the war and we have inflation. Inflation is an offsetting factor because it's going to subtract from GDP. It'll keep GDP lower than what otherwise would have been the case if we had normal or lower levels of inflation. You had a pullback in oil today. I don't think that is the beginning of any kind of a downturn in oil. What I've seen again for, I don't know, this may be like the 13th or 14th week in a row, maybe more, that oil producers are net long WTI futures. They did do a little selling last week into the rally, so that is, I guess, somewhat of an interesting development. But overall, they are still net long by a very, I think, significant amount, 90,000 contracts. That's net. That's longs minus shorts. So that's what, 90 million barrels. That represents 90 million barrels of oil. So they've been long for, like I said, maybe 14, 15, 16 weeks in a row. They've been on the long side of this whole move up. And until I see them flip around to the short side, I think you got to stay with them, because they have been very, very correct in their call of prices. And they're just, they may be selling a little bit on a rally now, but, that could be a 1 week deal. And until I see them flip around to the short side, I think oil prices are going up. What else is going on? We're getting, I guess, when is the Fed meeting? That's May 16th. So we're going to, plod through April, probably with some more of this back and forth price action. But you got to play the long side. And I think you're getting an opportunity here with this kind of meandering market, because it's going to keep the pessimism elevated. Market's going to climb the proverbial wall of worry. If you've probably heard that expression, that's an expression we used to say on Wall Street. The market climbs the wall of worry. And again, there's a lot to worry about. The war. Hey, 100 million degrees Kelvin. That's something to worry about right there. So yeah, gold, we saw once again in the week ending last Tuesday on the dip. Gold producers were aggressive buyers, I have to say it. It wasn't just short covering. I mean, they were adding new longs to their position. They're net short, but a very low short level for them. And we see them, the same pattern. Every time you get a pullback in gold, they are there, they are buying. And I think that indicates there's good support under this market, and they're going to be there. So when you see those pullbacks in gold, that's an opportunity to step in, either buy some gold stocks, buy physical gold, buy futures, whatever. I mean, the producers have been steadily buying on those dips, whether it's short covering or, as in the case of last week, it was actual new long positions that they were initiating. So that's basically the rundown. We're still in a bullish environment. Sentiment is negative. That's going to flip around. I told you that we're going to be having this discussion, months down the road, where I'm going to be telling you, hey, we got really elevated bullish sentiment. We have very low bearish sentiment. Maybe something will be changing in the picture fundamentally. Like I said, maybe it'll have to do with the midterm elections in November. I don't know, but we'll be, discussing a completely inverse, at least market psychology at some point down the road. But we're not there yet. I mean, right now we're still in that psychological climate where people are worried, they're nervous. It's reflected in the sentiment indicators. It's reflected in the put-call ratio. And that's a good environment to be buying. It's a good environment to anticipate higher stock levels, which I think we're definitely going to see. As long as that fiscal holds, and as long as we don't have some, who knows, really bad escalation in this war, and I think, we're going to start to see the market trend back up slowly. And these little dips, you want to be a buyer on these little dips. Bank data, let me just mention the bank data. Another week of increases in loans and leases. It was the 6th week up. Loans are growing at the fastest rate in 2 years right now. Banks have been liquidating treasuries, agency, and MBS securities. Banks have a big open loss on their securities position, and that's reflecting what the anticipated Fed monetary policy and the rise in bond yields. So bond yields go up, bond prices go down, and banks have to mark that to the market. But the good news is their residual, which is their capital, that's the assets minus liabilities, that is up to a 3-month high. And capital is the most important thing because that is the only constraint on bank lending. So as long as that capital is going up, that's the fuel that we need to see for more bank credit. And right now, as I've been saying, the combination of strong fiscal and strong bank credit, I mean, that's a powerful combination for the economy. As long as the economy is going to stay supported. I mean, if you look at last Thursday, we had the lowest level of weekly unemployment claims in 50 years. What I track is the daily flows of unemployment benefits. That's really, really low right now. That's another indication that labor market is good. So everything lines up pretty good. I mean, it'd be nice to see this war end in some kind of a ceasefire, peaceful conclusion, something. But financially, fiscally, economically, things are okay, and that's going to be positive for stocks. That's it for now, folks. See you tomorrow. Bye.